All right, what's going on, everybody? It's Friday. Woo, good times. Hopefully, everybody had a good trading week. The kill zone between 2 and 4. Yeah, the I don't know when I first started trading futures, everybody used Ninja back in the day, um, and I had no experience with futures when I got to it, and I think that's one of the reasons that I don't really like it. But looking back on it objectively, they're okay. There's nothing wrong with them. But man, I hated them when I first got started because if you weren't willing to buy the product and you just used the free version, they wouldn't help you with anything. They would just refer you to their help blog and say, if you're just going to use our free product, then there's our help blog over there. Good luck. And I found that really frustrating because I didn't know anything about trading futures and I had never tried to hook a broker up to a server before. It was just really frustrating. But now, looking back, I'm like, I could probably run it pretty good. My other issues with Ninja is their mobile is a separate entity that I heard you can buy now. But back when I was there, they didn't even have a mobile. And if you're on free, then the dome doesn't give you everything that any other broker's dome would give you, like order flow material, tucked in there to see indicators, to see order flow. You're not getting all of the data in the dome that you should have because you're on the free version. No, I'm not that old. Back when God turned the lights on, yeah, I'm not that old. So, I mean, they have bought other products since then, and they've done some updates. And if you're willing to buy the product, then a lot of my complaints go away. Because if you own it, it's a really nice platform. Right. Yep. Oh, absolutely. That's okay because you do equities and options, and so you'll get your money's worth out of it. Well, hey, one thing that you're gonna want to do, since you're getting all these pop outs, is take a look at a thing called Power Toys. You probably already know what that is, but for others who don't know, it is a Windows Edition product that you can install. It doesn't cost you anything; it's free. and it gives you all kinds of fancy tools. One of them is called um, Fancy Zones. And Fancy Zones, notice my screen, if I grab something, I need something to grab. Let's just grab that. And I hold a button down, it asks, what zone do I want to put it in? And I built those zones. I made them to be the size that I want them to be. And so I can tell it, which monitor I'm using and what the zones are, and it will snap right into place because that's what I've told it to do. And that's really handy if you're going to run multiple window products like NinjaTrader. That way they'll just snap right into their place once you've formatted your screen exactly how you want it. Turn on fancy zones and lock them into place. Hotkeys. You can build multiple fancy zones and then swap with hotkeys from one fancy zone to the next. Yeah, yeah. It has a lot of features, and I gotta say I'm not using it for much. I really only use it for the fancy zones, but it has other things in there too. I only use it for one thing. It's kind of like having a hammer and then using that for a paperweight. It works really good for a paperweight. So there was some questions about expected move, and it kind of ties in with the other questions on how I use fibs and quadrants. But let's start with everything has quote an expected move. Everything, even you, right? The way that we move and how fast we move, everything has an expected move, and it all comes down to how long do we give it? Are we going to do an expected move for the hour, the day, the minute, the week, the month? What are we doing? Because just like driving your car, if you're driving 60 miles an hour, but you only drive for 5 minutes, well, you're not going to make 60 miles, right? Because you only drove for 5 minutes. So when we're going to try to establish expected move, we have to define for how long. And most of us day traders, we just focus on the day. I mean, that makes sense. How far could we move today, which is different than how far should we move today? And to do that, a lot of them, they're already built in. So let's go take a look at options, because options is where most of this work gets done. Even if you don't trade options as a futures trader, you're going to want to know where the options data is. If you don't want to use options, I've got solutions, but different math gets you different results. So here on the options tab, I can look at today's options, which is the zero right here. And there's the expected move for the day. We have less than 2 hours until the end of the day. And so this is between now and the time we close, right? That's where we're at right now. We got a 23-point expected move between now and the end of the day. Okay, you know what I mean? It's 2 hours. What do you expect? Between now and Monday's close, we have a $73 expected move. 74 if we round up. And if we look at how far could we move between now and Tuesday, then we've got a 96-point expected move. Now, when I say 96 points, what I'm referring is where we are now and then moving down 96 points, or where we are now and moving up 96 points. 90 and 90 is 180, and then 6 and 6 is 12, so that's 192 points wide. That's our entire expected move range from high to low, right? So that's expected move. If you don't want to use futures to get that, then you could use something else like uh, ATR or ADR. The most popular one for non futures traders or non day traders is the ATR, the average true range. You would want to turn that indicator on, and then you can average it over 14 days. I like to use 20, which is a market month. So you open the indicator up and set it to 20 days. And what this is doing is it's looking back over the last 20 days and it's answering the question, hey, how far have we moved on a day to day basis over the last 20 days? and our average daily move has been around 68 points. That's what it says. So we could anticipate that if today is going to act like it did any other day, it's going to move about 68 points. But that's not necessarily saying that we'll move 68 points in one direction. We could move half of 68 higher and then half of 68 lower, right? Because just like with the ES that we were looking at, the expected move on the options, this is giving you the entire width, not just a single direction, right? So the other one was giving us a plus minus. This is not. This is giving us the total. For a quick shortcut here, while we're talking about this, there's a question about NVIDIA. Any projections or predictions on NVIDIA? Yeah, that it's not going to crash and burn, right? That's the anticipation about NVIDIA. It's down because everything else is down. And when everything else isn't down anymore, this very likely isn't going to be down either, right? It really is as simple as that. The entire marketplace is down. So guess what NVIDIA is going to do? It's going to go down as well. It didn't have really bad news, right? Just the market's down. Ta-da, done. Look at Apple. It's down. Well, it's got earnings too. You know what I mean? Like we could go through the list. What's down today? Almost everything. So what's Nvidia doing? It's down too. Why? Because everything's down. See this red map? Everything's down. Especially anything tech. All the tech stuff down. Finance down. There's tiny little pockets of things that aren't down, like some drugs, Eli Lilly, Johnson and Johnson, Merrick, Abbey, those guys. A little bit of retail, like Home Depot, some food, McDonald's. But for the most part, the Nasdaq is down, the S&P is down, the Dow and the Russell are down. So Nvidia is down. Predictions on what's going to happen to Nvidia would tie right into what's going to happen to the rest of the market. What's the ES going to do? What's the Nasdaq going to do? And the short answer to that is nobody has any idea. Most analysts say that this is just a pullback and we're still bullish. Until that is disproven, then we're stuck with this is just a pullback and the market is still bullish. We didn't get anything from Powell to break that behavior. We didn't get anything from QRA. We didn't get anything from the job numbers. Nothing has broke this market yet. So we need to see price show us that it's broken. And that would look a lot like this: lower highs, lower lows, lower highs, lower lows. And we don't have any of that yet. We just have a pullback. Until this pullback runs up and fails to make a new high, we don't have anything. This isn't even our low yet, right? Like back here, we at least set a low and then moved off of it, or we set a low and we moved off of it. This isn't even our low because we haven't moved away from it. So we can't look back yet and say, do we have a lower low? Don't know yet. So when we take that over to NVIDIA, same, same. This is the low that we need to break to get a lower low. We don't have that. So we don't have a lower low. We got nothing. We have to break this low and get a lower low, and or we need to break this high to get a higher high. So expected move. Since everything has expected move, anything can be projected. Penny stocks, options, regular stock, ETFs, it doesn't matter what it is. Even the turtle in your backyard has an expected move, right? Like everything has expected move. So you can use the indicator, especially if you're on a platform that doesn't have options, say like TradingView. You can connect TradingView now to some options brokers, but it doesn't have all of the data yet. So uh, it's very limited in how much options data TradingView can give you, but it still has things like ATR, which is perfect because it can still give you an expected move model. So anything that you want to look at, you can project. But what if we want to add some time to it, right? Say, like from a swing trader's perspective, what if I wanted a forward outlook of how far we could move within a given time period, like the next earnings on a stock that I want to trade? We'll use NVIDIA since it's our whipping boy today. So let's bring up NVIDIA and another indicator called cone of expiry. So when we load that, it gives us this big purple half circle and random numbers floating in the middle of nowhere. We need to turn more information on. So go to the gear icon, look for Friday expiration, which is under price axis, I believe. And maybe it's under time. There it is. It's under time axis. We want show expiration Friday. That's OPEX, right? So every third Friday of the month, we get options expiration. Now we got these red lines and it lines up with those prices. So with those, we can see, although I get it in the stream, these numbers are going to be really hard to read. Here's August, September, October, November, and December. And we can line it up and say, well, from where we're at, what's NVIDIA's expected move between now and the August options expiry? It is down to 157 and up to 188. That's our expected move for that time frame. If we want to trade, into September, then it's down to 144 and 202. You get the idea, right? And you can just keep going out farther and farther and farther. But again, this is a tool that's not looking at options. So you should find something like that on TradingView if you don't have options. If you have options, they have something that's better than this, right? So if we go into the Analyze tab, we want to go to the probability analysis button, not the risk profile button. We go in here and we open this thing up a little bit. It looks complicated, but don't let it scare you. Down at the bottom is how many days we want. And then on the side is the price of the market that we're looking at. So we'll put NVIDIA in there. And now we can say, hey, at 40 days out, which is 9/11, what's the expected move model from where we're at right now? And that's at like 172.3, right? I'm just kind of hovering my mouse there, so price might not be right there. And we can see 146.30 underneath my mouse and 200.77 above my mouse. That's the plus and minus of how far we could move in NVIDIA between now and 9/11. This is based off of the options pricing model. It's reading what are traders predicting for our move because it'll read the options and then use that data to calculate the expected move model. Every broker uses a different probability model formula. So if you have multiple brokers like I do, and you check it between, say, Tasty Trade and Thinkorswim, and they don't match, don't be surprised. They don't use the same formula. They all use the same data because, it's the data that we all have, but they calculate it differently. They won't be vastly different, anyways. They might be a couple pennies one way or the other, maybe a dollar at the most. But at the end of the day, it won't break the system, right? So don't be surprised if they don't match. Just like moving averages won't match between brokers and that sort of thing, right? That's just the way it goes. So some argue that this is a more accurate expected move. I don't like that word when it comes to this situation. Accurate isn't really the problem. It's it's just data, right? But the one that we used on the charts was looking at what price has done and then pointing forward what we could do next. And what this is doing is looking at how traders are trading the options and then projecting that forward on what we could do next. They're both giving you the quote, what we could do next answer. They're just getting it from two different sources, right? So it's not better, it's not worse, it's just different. I have this little, like, yard buggy that I use. It's got big fat mutters on it. I could drive it around and I don't get stuck in the sand. I go down to the creek and it just goes where I want it to go. But can it outrun my car? Oh, heck no, right? It's worthless for getting on the interstate, going to get groceries, even just, cruising around having a good time. That little buggy ain't going to do it, but it's really useful for what I want to use it for, right? So it's not that one's better or not better because I would never take my car to the creek. You know what I mean? I'm not going to drive my car in the backyard. So, not better, just different. But both of these tools can give you an expected move model. You'll just have to decide for yourself which one of those models would you like to use. So, we have that, and anything out there can calculate an expected move. So, we always have that. Another overlooked expected move model is implied volatility. So I'm looking at NVIDIA. I bring up the implied volatility indicator and it says 0.4625. What the hell am I going to do with that? Well, first, this is a 1 year daily chart, and that is a 1 year implied volatility of the VIX. And what this is telling us is between now and the next year, NVIDIA could move 46% higher than its current location or 46% lower from its current location. Those are some pretty wild numbers. Want to see NVIDIA get a 50% haircut? Because this says it could happen over the next 12 months. Back here, it could have only have moved 38% higher or 38% lower in the next year. I guess on the upside, it's not telling you it's going to go to zero. That's a pretty big move, but it's a 12-year model. And most of us, taking shorter term trades in equities than that. So you always have that too. But since it is a 1 year model, we've got some adjusted ones. I, I was just about to say, I think I have a volatility dashboard. This indicator is doing the same thing. You can see it's the same drawing on both of them, but it's got these labels. So instead of only giving you the 1 year answer of 46%, it's also giving you a monthly, weekly, and daily. But it's giving it to you in dollars, not percents. I think I turned the percents off. So you might be able to go in there and turn it back on if you wanted percentages rather than dollar values. So we can see NVIDIA in the next month could move $23 higher or lower from its current location of 73. We'll just round up and say 25 and 75. We could be at 200 or we could be at 150 next month. And by next month, I don't mean, how many days, I mean 20 days. A 1 month expected move model is 20 days. Volatility gets overlooked a lot when it comes to expected move models. So now that we've gotten that out of the way, and it was important to do that because there are a lot of tools that'll calculate that for you, right? One standard deviation models. There's another one standard deviation model out there that gets overlooked. Keltner channels and or Bollinger Bands. Now, this doesn't really do us a lot of good when we're on the edges, but if we're in the middle of the Bollinger, then we can look to the edge as how far could this market run? It could go all the way to the edge. That at least gives you a visual to aim for. And if we are on the edges, then you can look in the other direction and say, well, we could go to the mid because that's how far we could go from our current location on the edge of the Bollinger Band. What you'll notice about the Bollinger is it helps you visualize if we're in a high volatility environment where the market could go farther now compared to where it could have gone before. That looks like, say, let's just use some funny numbers. This looks like a 2% move, and that one looks like a 6% move, right? I'm just making those numbers up, but you get the idea that this is a much smaller move model than that one is. And that's because our expected moves for different products increases and decreases based on historic volatility. What we have been doing lately generates what we are expected to do next, right? Well, none of this projects the quality of a trade, right? It just helps us try to anticipate how far should this market move if we're going to move in a normal way. And as long as markets are behaving normally, they will respect these models. The problem is markets have a habit of not respecting the model simply because they're getting a lot of attention, right? Volatility is a fancy word for movement. When we have a low volatility, we have a low movement. When we have a high volatility, we have a high movement. And if we have anticipated volatility, which would be implied volatility, then we're expecting big moves. What I like to use to ask the question, have we been moving normally within our range? Is this really nice indicator called the weekly expected move. Generally, we only talk about this one with futures, but it's good for everything. We'll look at it on the video here for a moment. When markets are moving normally, they'll stay within their expected range for the week. The day, the week, the month, the year, they shouldn't outpace. For me, the week is kind of the sweet spot. Each day is almost too small, and then monthly and yearly is just kind of too big, quarterly. So I can look back and say, hey, last week, for an example, did we stay within our expected move range? This is last week. We wicked out, but we did close in the range. The week before that, we got out of it and we stayed out of it. So there's a break. The week before that, we got out of it but came back in. So that's a good one. The week before that was a good one. And then here's another one where we broke out and we closed outside the box again. 2 weeks in a row where we closed in the box. And then here's another week where we closed outside the box. So when we look back, we can say, hey, I like to use tens for this question. Hey, in the last 10 weeks, how many times did we close on Friday outside of the box? Tens give you percentages, right? So if we use the number 10 and I count back and I find 3 out of 10, then we've got this. 3 out of 10 is how I should have wrote that. And that's 70% model, right? But if I get a 4 out of 10, then it's a 60% model. If I get 5 out of 10, then it's a 50-50 model, right? So we can just use tens as a really round number, really easy number, and just count back. How high of a number do you want to see? Me? I want to see at least 70% because 70% is a one standard deviation. It means the market's behaving normally. If it's not closing inside the box 7 out of 10 times, I don't want to trust the expected move model right now. Doesn't mean I won't ever trust it, but different markets get different volatility. Apple, for an example, was getting a lot of bad news and started to break its expected move model back here, right? Earlier in the year, back in February, March, and then it just stayed down here and it was getting beat up pretty good. And it was breaking its expected range model consistently, like all the time. So, no way would I trust the expected move on Apple during that sort of behavior. But I was still trusting it in, Apple, not Apple, but the SPY, the Qs, other products still had a good expected move. You got to check each one individually and ask, well, how's this one behave? Is it doing good? Is it not doing good? And there's a lot of other indicators that you can use. I'm sure if you Google them, you'll find just a whole ton of them out there, Z scores and things like that. But at the end of the day, it really just comes down to trying to identify what product you want to use, price itself, or some form of volatility from options. One of those two products is going to give you your expected move. Technically, you could use both and then add them together, divide by two, and use the average of the two. But it just seems a bit of overkill, really. So that's one way to do it. The other is, where are we going next? Right? Like, hey, we're about to get a breakout. Where are we going? And while we could use expected move for that, I like to use my drawing tools because it is reacting to what we have, not counting back, X amount of candles and doing some crazy math that I may or may not understand, right? Because those expected move models use the square root of time. I'm going to pause there just to let that sentence sink in. It uses the square root of time. Huh? Yeah, I don't even want to try to explain it. So the textbooks, when it comes to price action, will talk about what we can do when we find a range. This is important because it leads us to day trading eventually, but we got a range. Every candle textbook out there will tell you the things that you can do to a range include measuring how wide it is, so we can take it from its highest to its lowest point, and we can project that measurement 50% higher and 50% lower. We can also take that measurement and we can go even farther than that and go 100% higher and 100% lower. So, what I just did there is I measured all of this range and I marked it 50% and then I marked it 100%. Now, these are called quadrant lines. And while I didn't turn them on, we could have used 25% and 75% as well. I know traders who use them. I do not. I don't want the 25 and the 75. I just want 50 and 100. Now, every textbook tells you this. It could be a head and shoulders, a wedge, a bull flag, a range. Anything that you measure can be considered a range, including one single candle. All right. If you measure, say, one daily bar, and then you go into a 15-minute chart, well, that one daily bar just turned into what, 12, 16 candles, something like that. So now you got a collection of candles within your drawing, but you only marked one bar. Of course, you could have marked a 1 week bar, open that on a daily chart. Now you got 5 bars, right? So any single bar can be considered a range and you can measure it because you can always go inside that bar and find multiple candles in it. This concept is taught in every single candle book out there. So if you're thinking, hey, I want to know more about this, grab a candle book because every single one of them will go into it. Unfortunately, they don't tell you how valuable it is. They kind of brush over it really lightly before they get into the juicy stuff, like what candle patterns are, right? And then they get into like wedges and head and shoulders, and they talk about all the sexy, glamorous stuff, and they leave this really important stuff behind, barely talking about it at all. In fact, the first three, four, five books that I read on candles, I didn't even catch that it was in there. I'm a speed reader, jumping through pretty fast, and I wanted to get to the juicy stuff. I wanted patterns and individual things like Marbozus and dojis, and just I wanted the good stuff. This is the good stuff. And they don't really highlight it that well, but it is in there. So we got 50% and we've got 100% of the range. If price breaks out and does not reverse, it will very likely pause at the half. Now, when it comes to penny stocks, those are what we call event driven markets. Technical analysis does not apply to event driven markets. If you ever doubt that, try to day trade in the futures when Powell is talking or when we're getting non farm payrolls and tell me how that works out for you. Those are event driven behaviors in the ES, the NASDAQ, right? You just get run right the hell over because, well, they're events. Something is happening and it's driving price, and it doesn't care about your measured moves. So you can't use these sort of projections on penny stocks effectively. You can do it and sometimes it'll work, but it's going to be like a 50-50 crap shot. And well, I like my money, so I don't do that. If it's an event driven market, it won't respect anything: pivots, measured moves, indicators, SNR levels. It's not going to expect any of that, right? It's just going to be pure flow. So if you're a penny stock trader and you're hearing any of this, approach with caution. Use Linreg lines or something. Those seem to work pretty good. For the rest of us, if a breakout sticks, it should pause at the half. If it doesn't and it keeps going, then it should pause at 100. And I know it says 2 up there, but this is 0 to 100. And if I project that 100% higher, then, we went from 1 to 2. So that's why it says 2. Once we got there, we could then change the entire drawing and we could mark a new range, for an example, and then we would plot that 50% higher and lower, and we would do it all again. So, quadrants. If we leave the edge and we come back towards the middle, it should respect the half. It's the way it goes, right? The half is a really important measure for a lot of things, including technical analysis. Take today for an example in Apple. We're still holding above this half. If we was to close below that half on a daily, I would be more comfortable with the idea of taking a short, for an example. Doesn't mean that the short would work. We're right on the line and we went down there already, and we came back up again. So, it's not perfect, but that would be the start of it, right? Like, hey, we closed below the big magical half line. I would be more comfortable in a short than a long if we were underneath that level. So, quadrants. Now, in all the fib books I've read, I don't like them. They're almost exclusively old books using old data and focusing on daily, weekly, monthly levels, and they don't really talk about the intraday at all. And different authors in those fib books all tell you you have to do it their way because they are right and everybody else is wrong. And if you don't do it their way, then you're wrong too. And I've proven them to be inaccurate because I made my own, just built it from scratch, ignored them completely, and mine is very effective. I like it a lot. And so I say, screw them and screw their model and screw their rules. Here's some of their rules. You have to go to the lowest point on the map to the highest point on the map. You have to, at least depending on whose book you read. And that you're on a 1-year daily chart. If you're on a weekly, some books will tell you 3-year weekly or 5-year weekly, never a 1-year weekly for whatever odd reason. Exactly, but the books won't tell you that. Depending on whose book you read, they'll tell you catch it from the high to the low. That's it. You do anything else, you're doing it wrong. I disagree with this, right? But that's what they'll tell you in the books. So I disagree on that and the time frame restrictions and the whole thing about wicks or no wicks. Just so I'm not telling you that you shouldn't read a fib book. Really, I'm not. And especially if it's a new fib book, something written in the last 3 to 5 years, give it a shot. You know what I mean? Like maybe, but otherwise, I wouldn't put too much faith into whatever you're going to get from a fib book, other than the explanation of the math. And I don't know, guys. When I want to watch TV, I turn on the TV, and if that darn thing breaks, I don't fix it. Right? I throw it in the trash and I go get another TV. Do you really need to know the mathematical formula for why 618 works the way it does and how it can be found in nature and the whole background and the math? Because if you do, if that backstory really matters, read a fib book. They'll tell you how it's in science and math and photography, and they'll give you examples and of leaves and caterpillars and seashells, and you just go at it, right? Enjoy it. Will it make you a better trader? No, but you'll have a deeper understanding of the history of the Fibonacci. Yay. You'll get that from books. When it comes to the actual application of using that thing, experiment. Try to just apply some lines and see what you get out of it. My lines, which by the way, I broke my fib, so we're going to build it from scratch. I'm going to reset my fibs right now, and I'll show you guys the lines that I use. So this is a default regular Fibonacci straight out of Thinkorswim. And I'm going to scrunch it up so you can see that there's lines way up here too. 400, 200, 100. I think there might even be a 600. Nope, it stops at 4. So we got all those projected overhead. We got 786, 618, 38.2, and 23.6. Now let's change some colors around. This 236 is also this 786. Is it perfect? No, but hear me out. You know that's the bottom side of this number. And the 382, that number is the bottom side of 618. I'll explain what I mean by bottom side here in a minute. Then that's the mid, and then you've got 100 and 0. All right, so now we've got some color changes here. Depending on how you draw the fib, your 100 may be at the top with 0 at the bottom, or if you flip that around, 0 will be at the top and 100 will be at the bottom. That's annoying, right? Because then you have to try to remember, which direction do I draw it in? Do I draw it from top to bottom or bottom to top? I just saved mine, so I'm going to draw it the other way around. And now you can see 0's at top, 1's at the bottom. Does it really matter? Nope, it does not matter. But if I want that quote 786 to be in the right spot, then I have to draw this in the right direction, technically. But what if we just swap it out for 236? So here I just did them in reverse. And you can see that 236 and 786, they're almost overlapping. Good enough for me. And in fact, I've done that just to get these little levels like this and mark them out with a box. but that's for advanced stuff. We're not going to get into that today. But you can see how they're really close together. What that gives you a chance to do is overlap it. But look at the 38.2. It didn't matter which direction I flipped it in. 38.2 and 68 point whatever it was, they're right on top of each other. So for your quote 618 level, if you leave the 38 something on there, they'll always overlap perfectly. And that helps you so that you don't have to worry about which direction you drew your Fibonacci in. Do you have to draw it from top to bottom to get 100 at the top, or do you draw it the other way around to get 100 at the top? That'll solve that problem. Now, when it comes to fibs, I draw them the same way that I draw quadrants. And the only quote actual fib number that I use is that 786. I turn off the magical 618. I never look at it. Same thing with the 38.2. So if you ever see a drawing of mine and it does have the 236, I only left it on there because it was the opposite of the 786. Otherwise, I don't even bother with it. These are the only fib numbers that I use. And then I added my own. At least this is from the books. All right. So I added more. First, I got rid of these. This 4236, I got rid of it, but I'm going to keep it here for a second. I use a number called 1236. Guess where I got that? I got it from right here. When I was evaluating the fib, I thought, what's this 4236 all about? We had a 236 here, 0236. And then I've got a 4236 out here. How come we don't have a 1236? Something a little closer that I could use, because when am I ever going to see price at a 4? So I converted that 4 to a 1. And I kept it just to see, if I liked it or not. But the 618, whether it was in the middle or a 1618 or a 2618, I didn't like any of those. So I turned all of those off. What I ended up with is something that looked like this. Okay, I can work with this. But what was bugging me is this middle area here between 100 and 123.6. If we get breakouts and those breakouts fail, a lot of time it stalls right in between those two numbers. It is driving me crazy because I want to catch failed breakouts. I love to short those suckers. I love it. It's one of my best trades. So if I'm going to spot a failed breakout, I really need a midline here between those two. And I needed something that's easy to remember. So if you get the calculator out and you take 236 and divide it by 2, trying to find the middle of it, you get some crazy wild number. And I just decided that 111 was good enough. And so that's what I started using. It's 111. So now we've got 111 and the 1236. You know where I got the 236 from. It was in the middle here, and it was projected like way out at 4 somewhere. And I experimented with them to see if they were going to give me any real value or insight, because I didn't know. You know what I mean? Like, you never know until you try. So I put them on there, and my first goal was to prove that they have merit, that they have value. If I could prove it in the past, I could trust it enough to start trying to apply it forward. I knew I wasn't going to waste my time if I could find it in the past, that I would begin to try applying it in the future. Not to trade with, right? Not yet. Just, I don't want to waste my time trying to put it on today's market if I have no idea if it's even going to fit, right? Does it work? So I went in the past and I started applying it to old markets. Well, of course, you have to start asking the question, what do you measure exactly? Do we do what the textbooks say and go from the highest point to the lowest point and only that? Or can I just measure any damn thing I want? And the answer is you can measure anything you want. Of course, that's very vague, and new traders are hopeless at that point because there's no rules. You got to have rules, right? Telling you that you can measure anything is worthless because, well, there has to be rules. So I made my own. If I want a daily measure, for an example, then I can't use the one that's open because, well, that day's not done yet. That's my rule. You can make your own, right? So if I want a daily, I have to use a day that's already closed. Can't use today's, not from a daily, anyways. I can go into an intraday and I can measure all of today's, even though the day isn't closed. Sure, I can do that, but now I'm on an intraday chart. I'm not sitting out there on a daily somewhere. So all I did here is measured the highest part of the day to the lowest part of the day, and that gave us our mid. If we were to break out, then we've got the 111 and we've got the 1236. Remember, I already said it. If breakouts fail, it will very likely fail against the 111. That doesn't mean we can't get through it and get to the 123 and then fail and come back in again, because we can. But more often than not, if the breakout's going to fail, it'll just stall at 111 and it'll come back in. And as for the question about videos on it, we took an entire afternoon 6 months ago or so and did the same stream that I'm doing now. Unfortunately, when the streams get posted, there's really no description added of the topics we covered that day. So I went hunting over the weekend to find something that would listen to the YouTube video and then give you a description. I found a lot of programs that will do that if it has closed caption, and these videos don't have closed caption. So I don't have a product yet. You know what I mean? I haven't found something. This is Thinkorswim. Um, yeah, I mean, daily pivots are great. You know what I mean? But they're not hand drawn levels, they're math formulas. And we did pivot points Friday of last week, I think, is when we talked about daily pivots, weekly pivots, and the formula and calculations for the SNR levels on pivots. I like them, but they're stuck in one spot, and if we gapped up really big and then we open on a day or we gap down like today, the floor pivots are going to be out of line. They're not going to be anywhere near the price action that I'm working with that day. So I like something a little more dynamic. So if you just determine everything that I've said, you could take everything I said and you can apply it in different ways. That one single bar that we were talking about earlier, you can apply that on an intraday, like the 5 minute open range, right? Think about that. The 5 minute open, it's just one single bar, and you can measure it with this, just like we measured a daily bar. If you have any reason to pick on a single candle, say the 830 uh, non-farm payrolls candle that we got today, any really big bar that stands out, event bar, what they would call it, then you can measure that instead, right? So if I was to measure the 830 bar, today's wasn't big, but it could have been. And I have measured, like CPI, non-farm payrolls, PCE. You measure that one bar and start projecting its levels out, like 1.5, 2.0, 2.5. You can map out the entire trading day. No, I don't need to redo what we covered last week. It's recorded and you already know it was last week's Friday video. All you got to do is go in and watch the replay of last week's Friday's video. So if we measured that 830 candle this morning, and projected it to the downside, we didn't get enough projections. We need another one. Maybe a 3 and a 3.5. There's our 3.5. There's our 3. So price got to the 3. That's where it stalled, ran back up, stalled at 1.5. But you see how all I did is measured the 8:30 candle. It's not like we had anything more than that. That would have got the day started. Because one of the things that we have troubles with is, well, at the open, we don't have anything to measure, right? The market just opened. This would have given us some structure into the open. And then once the open has been open for at least a half hour, then you can use intraday price action within the trading day itself, right? That's what I like to do is swap over. So in the pre-market, when I'm trading at 7:30 in the or not 7:30, 5:30, 6:30 in the morning, I'm using yesterday's measures. Anything from Globex that I can measure, anything from yesterday's price that I can measure. Once we get into today's trading and we get, say, a half hour, maybe a little bit more, then I swap over to use the drawings inside today's price action. So rather than doing what you've seen me do by adding levels, taking them off, adding levels, taking them off, on Thinkorswim, you've got two different drawings. They do exactly the same thing, but you have two. One is this one, it's called Fibonacci retracements. And then one is this one, which is called quadrant lines. So you can set one of these to have, for an example, all the 50s and hundreds, all the way out to like 5 0 and 5.5. And then you can use the other one just for your 111s and your 1 2 3 6s with the 7 8 6 tucked into it. Right. That way you're not changing the drawing back and forth, back and forth, back and forth. And if you're on TradingView, you can just save the setup and you can have as many as you want. Right. That way you've got your default, and then you've got, default 1 2 3, and you don't have to keep changing it. Plus, TradingView's got like 3 times more levels offered in its tool than this one does. Just build it how you want it, and then come in here and save it. Yeah, or swap to the other drawing, right? With TradingView, rather than using multiple indicators or using a code or making something, if you just go to template, you can do your basic levels, save it, and make as many of those as you want, and then just turn that one on for what you're looking for, right? Like I just turned on my defaults, and there it is with a cloud. I didn't save the old one, I should have, but if I had saved what I had, then it would take it back to what I was using before I clicked the button. And that way you only have to draw your stuff once and then save it. And whenever you want it, you can just go in there and go back to your basics. See if there's a reset button in here. Pretty sure there was. Apply defaults. That's what I wanted. So pretty handy, right? You can trick it out many different ways. I like TradingView because it lets you put words on the lines that you draw, and I really like that. That way, I can snap my levels, and I can go in there and put in like um, individual sentences on the line that I want, and that's really nice. So here I've got trading views lines. And when I put my mouse there, it just asks, hey, you want to add text? Sure. That's the liquidity zone, and that's the OCC zone. Done. That'd be your key level. And just like that, and I like that you can do that. I wish Thinkorswim would add that little feature. It's a little feature, but it's still a really great feature. It's better than having to, especially on Thinkorswim. If you add words, then you change your time frame of the chart, or you zoom in or zoom out. Those words get blown all out of proportion, or they're so small you can't read them, and it's just a mess. So I like that. That's really nice. Now, the application of these drawings is something that takes a lot of time because you got to build trust with them. What can you measure? What's the rules for your measure? Are you going to use Wix or not Wix? Like there's more than just anybody could ever give you with a book. And learning to trust them comes from having applied them and seeing the outcome enough that you're like, yep, I trust that I'm doing it right, that I'm reading it right, and that I'm analyzing things the right way, and that this level is the next level in play. You'll never get that unless you actually do it, right? No book in the world is going to get you there. You have to go out and do the work. Here's some examples of doing the work. Now that we've gone through my levels, you'll recognize the levels on the screen here. There's the zero line, the halfback, 786, 100, 111, and 1236. What I'm measuring is yesterday's intraday price action. We know it's not everything because we can see this Globex wasn't captured, so we don't know what's over there. But what we do know is it's all of yesterday's highest to the lowest, including the wicks, the body, everything. All of yesterday. And what I'm focused on is what are we doing in today's price action? There's my 111 reversal. I put the date of this market so that I can go back and find that exact day again if I want to. So in case I want to do more work, or maybe I have questions, I want to change the time frame. That kind of work is how you learn to trust that you're doing it correctly, that you can find your setups, that you understand what you're doing. It's because you've gone in the past and you've proven it enough times that you're ready to start doing it in the future. So that, say on Monday, you would look at Friday's range and measure it out and have these levels and be ready for a breakout. But if I just showed up out of the blue and was like, hey, you should look for a flip on the ES today when we get down to 59.36 because it's my 111, and you hadn't heard us talk about this today, why would you trust me, right? You would have no reason to. We could, right? This is just one example of what we can measure. Just one. We could also measure only Globex if we wanted to, right? Just that, only that, and nothing but that, if that's what we were focused on, right? And as we get near the open, a lot of times that is what I'm focused on. You know what I mean? There's nothing wrong with that. This isn't an either or situation. This is, hey, what can I measure? You can measure anything. I like measuring yesterday's Globex range. Absolutely. You can also measure everything in the entire trading day from yesterday. So I'm going to do that now. But rather than squinting at these candles trying to get it right, I'm going to measure yesterday's trading range, and we're going to do it from the daily candle. So we'll just zoom in here. There's yesterday's low, and there's yesterday's high. Done. I didn't have to, try to zoom in and get it perfect. And screw around, just done. But I'm missing some lines. So we need the other direction. Oh, I'm out of curves. All right. Well, we'll just use that 3.5. That way we've got it going to the upside and to the downside. Right now we're done with the daily. We can zoom back in again. So there's yesterday's 111 and 1236. All of it, not just the Globex. Yeah, when I got so frustrated with the fib books that when I started working on my own, that's really what I focused on is my own. Um, the takeaway is there's nothing magical about mine, right? No, Globex is price. So when I say Globex, I mean price. Anything outside of the regular trading hours, anything outside of that is Globex. If we were looking at, say, Apple, we wouldn't use the word Globex. We would use the word after hours and pre market. But if you're talking about, quote, futures, then we use the word, well, I use the word Globex. And Globex is just a phrase that means it wasn't in the regular trading hours. Global extended hours, Globex, global extended hours. So it's extended hours for global markets like futures. So you can draw this anywhere. You can practice, you can experiment, you can come up with your own stuff. There's no wrong way to go. And that's what I want to encourage you to do. The problem is a lot of people don't want to experiment. They don't want to practice on something. They just want answers. Like, just tell me how to do it. Get your pen, tell me how to do it. What do I do? And you can't you can't trade that way, right? We're not making a cake. We're not assembling a car. This isn't a step by step 1, 2, 3 process. When it comes to trading, not just drawing lines, but actually trading, you've got to be dynamic and flexible, evaluate the information that you have to make an informed decision about what you want to do next. And that does not come from step 1, step 2, step 3. It comes from understanding the process and making an informed decision afterwards. So when it comes to these drawings, you can uh, you can draw a line on anything. I've done it on 5 minute candles. I've done it on 1 minute candles. Just one single 1 minute candle. I've snapped a quadrant line on there before. You can use all of the overnight hours or leave them out completely. All of the RTH, you can do one for the entire week. You can skip the wick. You can add the wick. You can do it on Heikin Ashi. You can even do these on indicators. I've put quadrant lines on RSI, MACD. I've put it on market breadth tools. I've put it on the VIX. Hold on, guys. Like I can't talk and type, so I can't chew bubble gum and walk. So to get used to this, the way that I found it to be most practical is to write out a set of rules for yourself, right? Your rules. And I stole a lot of my rules from the candle books first, and then I adapted them to suit my needs later, and I locked them into place and said, these are my rules. Now, the cool thing about my rules is, well, they're mine. I'll break them if I want to, right? But you don't want to break your rules. It's kind of this, I don't know if it's me, but I don't like being told what to do. And I don't like other people telling me what my rules are. And I tend to ignore them and I break the rules and I do whatever the hell I want. But when it's my rules, I'm not allowed to break them. Doesn't mean I don't, right? But I tend to be more respectful of the rules when they're my rules. They're mine, I made them. So I tend to respect them more. You can start with some basic rules that are out of the books. And then as you go, you can develop your own rules for how you want to do things. And that doesn't mean that you can't ever deviate from the system because, well, if it's your system, you can deviate it when you want. Just that you need some guidelines to kind of keep you into play. Some basic things that I don't like to do, right? That kind of highlights I don't like to put a fib onto something if it isn't closed yet. That's one of the rules that I'm really pretty solid about. And I rarely ever break that unless I'm trying to answer somebody's question, right? Like putting a fib on a daily. If the daily isn't closed yet, I don't really want to put a fib there. But I have, and I will, but I don't like it. And I don't really trust it. I certainly won't trade off. I won't trade off of whatever answer I get. I also don't like to I don't like to measure out short days by themselves. I usually just take that short day's information and I add it to the previous day's range and I treat all of it as the same amount of flow from a single day. That's my rules. I do what I want with them. But when it comes to using the wick or not using the wick, it really depends on what I'm trying to do, whether or not I'm actually going to use the wick. And I'll give you a really good example. We were doing it today. We were in the chat and we were talking about, hey, where's your drawing at right now? And at the time, mine was right there. It's where my line had been all day until we got down here to the 1, 2, 3, 6. But and I'll back up to when that talk was taking place. It was somewhere around in here, right? Somewhere like that. I'm willing to move this to the low of the day. At the time, that was the low of the day, simply so that I can see where the real midpoint is at. Because this is the real mid at the time. It's the absolute high of day to the absolute low of day, and that's the absolute real mid. But once I got that mid line, I would draw a line there and then put my drawing back where it was, right? So there's a line for the real half, and then I would just put my drawing back where I had it. Once price got down here and hit that's not where it belonged. Hold on. It was here. Once price got down there and gave us the OCC off of the 1, 2, 3, hey, it rhymes. Then I would have updated my drawing and now I would need a new half. But by the way, look at how that worked out. You got to love it. So just temporarily, I would grab all of the day's trading, highest to lowest, move the marker, and then put my lines back. Just a second. All right. So that's one of the rules that I have on moving the drawings is that I will readjust it to catch that midpoint. And then I'll put it back again. Also, what I'm measuring has context or has value, right? Like in the Globex, before today's trading range opens, we have to leave the Globex range before anything else is going to take place, right? So I don't really care what yesterday's levels are. If we're still inside this Globex range, it's not going to matter. And then all of yesterday's range won't matter if we're still inside of just the RTH range of yesterday, right? So, when people say, well, what's more important? The one that's closest to you, because you got to get through that one to get to the next one to get to the next one. I showed earlier today in the chat too that since we can measure anything, if we have a push like this from here to here, we can measure that, put a half back on it. We can put, 111 and 1236 above and below it. We could measure just this and catch the half, put a 111 and a 1236 above and below it. And even now, in just this little micro range, we could measure just that and put a half back on it and a 111 and a 1236 above it and below it. Anything can be measured, right? And it doesn't matter if you're on a tick chart or, Renko or whatever. But I found that consistency really helps. When I'm doing analysis on my drawings and I'm trying to identify the next turning point, the next pause, the next breakout, I stay on one time frame and I only use that one time frame. It doesn't there's no magic in it. If you like to use a 1 minute and that's what you always do that. Or a 2 minute. I know 3 minute traders, they love the 3 minute. Do that. I don't care. I use a 5 and I always use a 5. And so that's what I always use. And if I go to draw a level and my chart's not on a 5, I'll put it back on a 5 just to draw the drawing and then go back to whatever level I was, right? Say I'm on a 2, I'll go to a 5, draw the drawing and go back to the 2 afterwards. My rules, right? But my drawings, if you was to go scrolling back through the chat over the last few years, you'll notice a consistency to the drawings. They look exactly the same every time for a reason. So I'm trying to stay as consistent as possible in my approach to how I use them. Now, in this picture, I used all of the price action. We can see the previous day, all of the Globex, all of the RTH, and I did that on purpose so that I know I used all of it. The picture's for me, but it answers my question. Hey, what did I measure? All of yesterday. Okay, cool. There's the 111 reversal. There's the 111 reversal. And there is the 111 reversal. On all of those, we were failing to get through the 786 until we finally did, which gave us our half. And it has the date there, so I know where to find it if I wanted to go back and review it. And I didn't mark it, but I could have. Take the high of that day and the low of that day and the midpoint of that day, because that's where we struggled. Or take the low of that day and the high of that day. That was the midpoint that we turned off of when that little bounce on the run back up. It works everywhere, right? The one that I keep showing in these pictures, it is my trade called yesterday's 111. I love this trade. Here's another one, March 3rd. It's just the RTH. We know that because I'm not really showing any Globex. 111, 111, 1, 2, 3, almost a 1, 2, 3, and down it went. Where did it go? To the other side, almost to the 1, 2, 3 again. Notice how if it fails to break out, a lot of times it stalls on that 111. And that even if we do get through the 111, we've still got to master the 1, 2, 3, 6, or we're going down. That's an zoomed in view. Let me go to the next one because it's probably going to give us some context. Yeah, here's November 4, big picture, the whole day. We can see it's the whole day because I got Globex showing and the previous days just enough to show me that, hey, I got all of it. And there's the 111. Now, what I did is I zoomed in on this area in this picture. That also I just highlighted was the cog line 32 32 is a cog, and this is a Cahold pattern. It's also a 786V. I love my trades. So here's the same trade, the same one, same thing. I got a whole folder of these things, right? It's how I grew to trust trading it. It's because I went back and found example after example after example after example of it, and I studied it. You can add more info to these as you go, right? Say you're a MACD trader or an RSI person, or maybe you're using something else, right? You can apply that too. But anything that you want to study when it comes to price, go find examples of it. Moving average crossovers, I did 9 months of work just like this on moving averages. And it got to the point where I know that I don't trust them. You know what I mean? Like that stuff don't work. But it doesn't mean they're worthless. Above, below, they give us value, right? Give us insight. But I won't trade like some sort of moving average bounce or anything. I'm not, there's no trust. So if you want to trade a setup, first find what that setup happens to be. For me, it's yesterday's 111. Find examples of it so that you can study it. Like, how did price react when it got to that level? What kind of price action did we get afterwards? What time of day was it when we got there? What kind of trading day was it? An FOMC day, CPI day? Was it a Friday? Because those things matter, right? Price acts differently on Fridays than it does on Mondays. Was it the end of the month, middle of the month, OPEX week? All of that's going to affect price. So find examples of your work, collect it, and then save it so that you can go back to it later on. I have all of these days in a book. I can just go to that day and see my research. To get started, I'm going to give you guys some of my criteria, and I want to stress that there's no magic to my rules, right? My rules will get you started, and then you can change them if you want to for your own reasons. Okay. But having something to get you started would be better than just throwing you out there to the wolves. Pick one time frame. For me, that's a 5 minute. Maybe you like a 15 minute or a 30 minute. Hell, maybe you're using a tick chart. I don't know. But whatever it is, pick one. You don't get to swap around to multiple time frames. You only get one. And for a little tip, it needs to be a big enough time frame that you're comfortable measuring one single candle. Now, I'm on a 5 minute and here's one single candle and it's not a very big candle, right? It just that's one random day out of all the days that I could have picked. That's not a very big 5 minute bar. Measuring that wouldn't have really helped out. But a lot of times we get a really big 5 minute bar at the open, right? So I'm not leaving my 5 minute. I like it. But you pick one and that's the one that you get to pick. The next thing is, where can you apply these drawings? You can put it on the open range bar. For me, that is a 5 minute open range. But if you're using a 15 minute, 30 minute, 1 minute, whatever your open range is, you can apply it to that one bar. You can apply it to all of the overnight price. I call that Globex. You can call it Bob. I don't care what you call it. Yesterday's RTH, it's just the regular trading hours only. All of yesterday, all of the current week, not counting your current day. That's a little confusing. I'll explain that in a moment. Last week, last month, if you want to go that far. So all week, but not today. What I mean by that is today's not done yet. If I'm measuring the week, especially if it's like 7 o'clock in the morning, I can look at Thursday, Wednesday, Tuesday, and Monday, and I can capture all of that in fib levels, which happens to just honestly be yesterday, right? Because yesterday we went high on the week and we went low on the week. So done. But what if we hadn't, right? Then I would have had, say, the low of the week and the high would have been Monday, for an example, right? You can also measure event bars. Now, the easy event bars to remember are like CPI, non farm payrolls, PPI, but you can also add things like the 1030 oil report, called the EIA report. You can do auctions like the 1 o'clock auction. There's another couple of, I think Jolts is at 10. There's some 10 a.m. reports that you can measure too. Can't remember them all off the top of my head, but any of those bars, if they give you a big fat bar, you can use it. And I've got examples of these bars because they're another trade called a liquidity gap. We can measure that liquidity gap always. And it happens everywhere, but the known ones are the easier ones. It's a bit zoomed in there. So this was a CPI candle, and it's a really big bar. We can measure that entire bar if we had, look at the projection. It's a 50% run of that entire bar. And look at where price came back when it fell back, it stopped on the half. I don't have the drawing lines there, but if we were to go back to that day, we tagged the mid and we couldn't get through it. We hit half on the breakout, we couldn't get through it. And we never closed the gap that day, by the way. But on this day, we did. Same thing, really big bar. If we had marked the mid, look where it stopped. Sure, it didn't turn, and stop falling there for good, but that was a really good 3 bar play, first touch play, 3 to 5 points, been a nice trade. Stopped on the mid, got back down, closed the gap by 10:30, 11 o'clock, because that's what they always do, 10:30 or 11. Same thing in the other direction, big gap bar day, stopped on the mid, made it back to the open. So you can measure event bars. Now, if you want to take those as a good starting point, that would get you started. And then you can add to it. I'll tell you guys one that a client gave me. I don't use it myself, but they really like it. Um, see if I can. We'll use this. This fits. So what they're doing is they're using part of yesterday and part of our current day's Globex to measure the trading range in that day, right? So we're talking about this day. It was last Thursday, or actually it was yesterday. So if we were trading yesterday, they would use Wednesday's price and whatever they got from Globex last night, right? So this Globex high and yesterday's RTH low, or all of yesterday low. Now I don't use this one myself, and I think I actually took a picture of this and put it in the chat. And I said something like, "This isn't one of my usual drawings." You know what I mean? Because it's not mine, but I'm learning it, see if I like it or not. I'm testing it out. I haven't had time to do a deep dive to go in the past and find a lot of examples of how I might like to use this, but I'm going to add it as an example of somebody took my idea and they improved on it for them anyways. They love this, and they they think it's fantastic. So there's no wrong way to go when it comes to these drawings. Hell, even the numbers that I use. I have a client that got rid of my 786 and they put the 618 back on there. I don't agree with it, but they love it. They do everything that I'm doing here. They just use the 618 instead of the 786 because that is the quote magic Fibonacci number or whatever, it is it is Fibonacci. So don't feel like you're stuck with the way things are. You can change it up. And if you're a scalper, then, try to experiment with these intraday swings. Nothing wrong with it. It's not like you're going to hurt anything. You're not trying to trade off of this. You're just trying to analyze, right? You can go back in the past and find other intraday swing zones where we set a new high and a new low or something and mark them out and see what happened when price retraced back into the halfback or broke out and tried to get into the 111 or the 1236. When we had this marked earlier today and we finally ran back up there and tried to break out, there's your breakout and the failure. And we came right back in again. You can measure anything. It also showed the halfback. But trust is only going to come from going back and doing it, right? I can show you a couple examples, but if you took the time to, especially on the market you want to trade, say you're a NASDAQ trader, if you was to go back on there on the time frame you want and find old examples, mark it out and see, hey, did it work? Can I just randomly, pick a day on a 5-minute chart somewhere in the past, snap yesterday's lines, and see how price affected those lines the next day? Let's just scroll back here and stop, zoom in. Well, we went through all of it, but that's where I stopped. So that's what we'll measure. A backup to measure yesterday. We already know it's a breakdown of epic proportions, but we'll do it anyways. There's the Globex tag. Then the 111 wasn't really able to keep it, so we came back, got the 1236, and then of course things got ugly from there. Let's keep that measure. Just turn on some of those halves. Nope, not really useful. Huh. It just was one of those real big expansion days. Looks like a headline day. Maybe tariffs or something? Not sure what it was. Headline days, they don't respect the rules, right? Oh, but on those days, not that. That's one time framing. That doesn't respond well. Take one of these days when we actually are trending. You can run this intraday. So that would have been our intraday at the time. Roll it backwards so we can do this, get these numbers out of the way. So if we were intraday trading and we had that and price pulled back and we're asking the question, hey, it got above 786. If it can do that, it can get to the half. Well, it didn't. It gave us this really beautiful 3-bar reversal and it started to dump. So we made it to the 1236 and we overshot it, but we did get our opposite candle color. That's what we expect once we get a candle close on the 1236. So we got it. Once the OCC closes, we can move the drawing. So bring it down. Now we got a new 1236 and a new 786. What happens? Price got there, overshot it, but we did get our 1236. So now we can update after that candle closes and we get another 1236. We got there, got another OCC. Now we can update the drawing again. Stalled out at the 111. Hey, there we go. Managed to keep going at that point. But it's a watershed moment. Looks like some really bad afternoon stuff. It didn't even stop. This price action right here, it's what we call one-time framing. I think Dalton came up with that phrase. If it wasn't him, it was the guy that taught him. But that would be farther back in the history that I know. Um, it just means that the candle didn't change color. We never got a pullback. There was nobody going the opposite direction in that market the whole time, the whole fall, right? It was like everybody was selling and nobody was buying. So we just fell, fell, fell. Headlines, some kind of drama, news, whatever. This stuff doesn't apply if it's some blowout price too, right? Like this. See those 3 really big bars? Well, 2, honestly, where we went from 17.5 to 19. Wow, 18.9. Massive. And if you are using the NASDAQ, maybe you don't want my 5-minute bars. probably want to use something else. 2 minute bars or I don't know. I don't know what you'd want to use. I use the 5 anyways, even if it is on the Nasdaq, but I like 2. If you're going to constantly measure the Nasdaq, maybe use 2 minute bars. Right? That would be fun. Marziti. Now on your platform. Ah, nice. So I don't know. Those books, I'm not poo-pooing on them and saying that they're worthless. Understanding the history of Fibonacci and all that, it has value. And maybe there's some modern books. I didn't look at the modern stuff. I have a bunch of books. I have a bunch of books that was given to me when I started trading, and a lot of them are old, and that they are what I use. So I don't know. Maybe you'll find some new material that's really great, but I didn't find anything in there that really gave me value or anything that I could use as a trader. So I made my own. And I get funny responses from people when I tell them I made my own. Like, oh, well, that's no good. It works for me. I mean, I trust it enough. I put money on it. That's all I need to know, right? And maybe someday I'll end up writing a book on it, and I'll be some big name like John Euler or Gerald Appel, Wyckoff, but I doubt it. Yeah, like the Beverly Hillbillies riding to town with the rocker under the canopy. Oh yeah, there's no rush. But you know, I I think there's more to learn because there's always been more to learn. Um, OCR style analysis has become bigger and bigger part of what I do on a day-to-day basis. And there's just no material out there. And I think I'm going to end up having to write a lot of it. So for those who haven't heard me use that phrase before, OCR, it's called one candle reversal, OCR. And it kind of fits into what we've been talking about. If I measure a single bar out here on a daily, you guys instinctively understand that that's a lot of 5 minute bars, 30-minute bars, 1 hour bars, right? As soon as I go to a smaller time frame, look at all the bars that are on that drawing. You know what I mean? Like, ta-da, that makes perfect sense. So when it comes to defining a range, for an example, we can pick one single day and say we have defined a range because all we got to do is go inside that one day and see a range of bars inside of it. In the technical analysis world, they always say, well, you need a lot of bars if you're going to do any sort of, technical analysis. You can't define where this market is in its structure by one single data point. You need multiple data points. And that makes sense, right? We can't do a complete history of the market from this one bar. But how many bars do we actually need? Because if I can extrapolate 30 bars from one bar, for an example, or even 10 bars from one bar, then every one of these bars is worth 10 bars. So what OCR style analysis starts to focus on is where was that high? Well, that's a new high. Let me back up so that that makes sense. Let's go over here somewhere. we'll start at the start of this run. We had a market that had developed a range, and on this day we broke out of it. That gave us a higher high and a higher low. Clearly. The next day, we got a higher high and a higher low. Now, if you hadn't done any OCR work, you would look at that and you'd say, oh, that's a doji day. You're not wrong, but let's add a little bit of information there. It's a higher high and it's a higher low and it's a higher close. Doesn't those three things sound bullish to you? Because they kind of sound bullish to me. A higher high, a higher low, and a higher close. Yep, that sounds not bearish. And it doesn't sound wishy-washy like a doji, because a doji is complete indecision. We don't know what to do next. Good luck. Higher high, higher low, higher close. And we got some doubt and some confusion because we're at the high and it's a doji. But I'm leaning a little bullish. Goodness. Yep, that was definitely bullish. Higher high, higher low, higher close. Same thing, higher high, higher low, higher close. And again, except here, things change. Higher low, lower high, higher close. If that was 2 out of the 3, we'd be better off, right? If we had a lower high and a lower close with a higher low, that would have been one thing, but we didn't get that. So now we've got some warning signs here. The lower high is the warning sign. The higher close and the higher low, those are positives. So we've got one warning out of 3 signals, and it just says, hey, approach with caution here. Maybe lighten the load, reduce position size a little bit, lock in some gains, and be mindful that we could break this low. But we still don't have anything scary yet because we closed higher than the midpoint of the previous day's range. So we're still good. Higher close, right? Yep, we're still good. Higher high, higher low, higher close. Same thing. Now the game changed, right? So OCR analysis, there's a lot more to it than this, but you get the idea, right? That one single bar can give us a lot of information that we don't need, you know, all of this to start to define trend, momentum, pullbacks, topping patterns, concerning price action. All we need is just bring in the candles that we have immediately in front of us and start working with them. OCR. One candle can call a reversal. OCR analysis. But there's no data out there. If you go looking for OCR style education, there's just like you just fall down a black hole, a rabbit hole. You go out into space, or fall down the Google mine pit. If you are struggling as an intraday trader, and we're talking about the drawings here, so I think this would be a good way to kind of summarize today. Map out what you have, right? You can call it putting lipstick on a pig, right? Or just making the charts look pretty. But some of this map works helps your mind until you get to the point where you don't need to draw it anymore. Like me, I don't need to draw it. I already see the midpoints, I see the breakout levels. I don't even need to draw it. But if you're newer to it, you do need it, right? Like drawing a trend line. I don't ever need to draw an angled trend line. I just don't. But if helping you see it means drawing it, then draw it, right? So mark out what you have on the trading range. Mark the open. Write down the word open. You know what else that is, by the way? It's a cog line, 6311. Let's put that word on the other side. So it's a cog line and it's the open. We could also mark out the 5 minute low, because for me, when I'm marking out my open range, that open range is the 5 minute open, high, and low. I don't worry about the close because that comes in later on with something else. So mark out the low a day and write it low a day. Mark out Globex high, Globex low. Mark those things out so that you see them, you recognize them for what they are. And if we happen to move around them, they become targets and levels to focus on. The more you can define what you have on your trading day, the more informed you are about where we could go next, what the next target is, what the next resistance is, because you've already mapped them out. If you do any sort of supply and demand, then do that, right? Add that to it. I'm particular about mine. I don't do it the the Kevin way, um, but do it whatever way you do it. If you have the space, have that on a different chart if you need to, so that you don't clutter up your trading chart. Like my trading chart doesn't have this stuff on there. I leave a chart like this up all day so I can throw it into the chat and help you guys with where the next level is, but I don't have a lot of that stuff on my chart. Not my actual trading chart. Keep the clutter off, but for analysis that's completely different, right? Mark out everything that you can. The floor pivot, the open 5 minute bar, the true close. If you use a 1 hour open range, mark that. Mark the close of Europe. That way, if we move anywhere near those levels that day, they offer value. But don't do busy work just to do busy work. What I mean by that is take a day where we open and we just fall away from the open and fall and fall and fall and fall, and we don't even try to go back to the open. Do you really need to mark the open that day? We never went back. We left it as soon as we opened. You know what I mean? Don't mark it just to mark it. If we're not going to use it that day and we're nowhere near it and we're not trying to go towards it, do you really need to mark it? And I say that because I've had people say that they spend 30 minutes in the morning, 40 minutes in the morning transferring all of their lines from yesterday into today and marking all this stuff before they can even get their trading day started. You'll get faster with time, but on the other hand, if you've got 30, 40, 50 lines that you got to move over, maybe dial it back a little bit, right? Especially if they're not even lines that you're going to use today. If if they're not going to be in play, do you really need to mark them? Just save yourself the work, right? I call it busy work. When when you're in a trade and you're trying not to mess with the stop because you're one of those people that like to fiddle with the stop, leave the stop alone, maybe go draw some lines, right? Just to stay busy and leave the damn stop alone. But if you're kind of in a crunch and you got to get things done and you're looking at moving lines from last month's high or something, I wouldn't worry about it if it's not going to come into play. Really? Trump orders the firing of the Labor Department official after a weak jobs report. He wants to fire the top Bureau of Labor Statistics official. It is a wonderful world we live in, isn't it? So hopefully today gives you guys confidence on drawing the levels. And if you're unsure, take a picture and throw it in the chat. You know what I mean? Like there, you've got moderators here all day long through the entire trading day. So if you're ever not sure, just throw it in the chat. Take a picture, hit us up, get some feedback on the levels. And Jeremy's going to be back sooner or later. I think he's got his own ways of doing drawings and levels too. That's different than mine and different than Kevin's. And at some point, you'll get to where you're going to draw your own, but it'd be a good start. Um, any questions on anything we went over today or topics you guys want to hit on next? Yeah, I appreciate that. I don't think you're far off the mark with buying the dip, but I will caution, that the CTAs have been feeding the fire all along and adding to the doubt and the confusion because we need a certain level of fear to keep the grind going higher. All of those people that kept trying to short helped propel us further. But at some point, we're going to see everybody trying to go long. They're going to believe that buying the dip actually works and starts putting some real money behind it. Nobody was really believing it at first, but the money flow is really getting up there. And once we get enough people believing that buying the dip is the right thing, they're going to rug pull and they're going to go the other way. I don't think we're there yet, but time will tell. Yeah. Oh yeah. After. Yeah, it's good to do something. There was a follow-up question from someone who got here a little late, so we're going to circle back on this. What I just highlighted here is the futures and the next Friday expiration. There's your weekly expected move, plus or minus. And since the market closed, this is going to lock into place. Not yet. It's still probably settling. I always say give it until 4:15 or 4:30, then it'll lock into place, and that'll be your expected move. It is a plus or minus, so it's 134 up from this level and 134 down from this level. And thankfully, we don't need to draw that, right? I can just come out here and go to my saved chart. There is next week's range right there. That's the plus. Notice it's supposed to be from Friday's close, but the gray line is down here. It's because it's still shifting. And that's why I say don't do it right at 4. Wait until after 4 because it's going to move until like 4:15 or so on settlement and everything. Even better if you can come on like Saturday or early Sunday, cool. Don't go late Sunday because Sunday night we're going to open and this thing, um, the one on the drawing page, the one on the options page, it will start to move again. So these lines come from the options derived by next Friday's expected move level. Not really though, right? Because the drawing does it. But for those who don't have Think or Swim, if you want next week's range, you do have to get it at some point after the market is done moving around. So you either sit here late enough in the day, like 4:30 or so, where this number stops moving, or just come back over the weekend and get it. Yeah, there's a when it comes to this weekly expected move, I always show it on the futures because, in the morning briefing is where I show it every day, but you can use it on everything, anything. So over the years, when I was making videos for the next level library on the Thinkorswim or on the Bullish Bears, I had to do videos on iron condors, butterflies, verticals, and some mechanical trade strategies. So I've done videos on how to use these lines for butterfly trades and how to use them for iron condor trades, how to use them for vertical trades. The reason I like the butterfly one so much is because we pin to these levels a lot, a lot. And a butterfly, you can put on a $5 wide butterfly on the SPX for 5 pennies, and that can net you $400. And if you're wrong, what do you lose? $5, 5 pennies, $5. It's the cheapest big trade that you can get. And I know $400 ain't, like, oh, big trade. Get 10 of them if you want to size up. You know what I mean? Like, make the butterfly bigger if you want to go that route. It's just a really, really cheap trade that can grow a small account. I have grown a small account from that. And I mean, like, took a $20 account and grew it. Because why? Because it's a tiny little butterfly. You know what I mean? Like, so I've got videos on that. It's on the Bullish Bears website. So what you want to do is go to the Bullish Bears and look in the next level library, especially for anything that talks about the mechanical options trading. They're um, for iron condors, verticals, and butterflies. Just don't do the iron condors, right? They don't fit right now. Yeah, and that I know that's confusing because we have a ton of stuff on YouTube. We do, but these are actually on the website, and that's where you have to go. I've talked to Lucian before about, trying to change that system, but he has a really solid reason for wanting to leave it on the website. So that's where they are. In fact, he wants to migrate more of our YouTube stuff onto the website. There's just so much of it that it's not getting done. So, but yeah, these expected move. And if you did search on YouTube, Bullish Bears expected move or not expected move, but mechanical trades. I did two teaser videos that I put out into the public years ago because I was trying to promote the Bullish Bears and the mechanical trading strategy. So you can get a little teaser just from YouTube, but if you want the in-depth stuff, go to the next level library on the website. And with that, guys, be thinking about what you guys want to cover next week. I need at least a good 45 minutes because I want to do an in-depth market review next week. But other than that, 45 minutes, if you guys got topics you want to cover, hit me up. We'll add them to the list. All good. this was recorded, so for anybody that wants to watch the replay, I'm gonna get it posted, and everybody enjoy your weekend. Yeah, yeah.